So in our section E, we are going to be looking at the technical and fundamental analysis, and this is a very big deal in the market. This is where the money starts coming in. This is where the magic happens, and it's a very big topic. It's a wide topic that I want you to take care and be extremely keen, because we are going to be using all this in trading. This is very crucial. You need to get your notebook and note. So we are going to look at what technical analysis is, candlesticks, techniques. We look at the indicators, time frames, support and resistance levels. We look at the trend lines and how they work. We look at the fundamental analysis. We look at the fundamental drivers, and we look at analysis paralysis. We get more detailed about all how they work and how they can help us to become more profitable into the financial trading world. Let's first look at the importance of all analysis. So that is the technical and fundamental analysis. So we look at for a period. Let me expand it a little bit for us to see clearly. So we look at for a period of long time, there has been a talk among traders about technical and fundamental analysis to see what's the best that helps them to make money. So according to my research, the analysis is needed for you not to lose money, a lot of money in the case of news releases. So that is fundamental analysis actually. So you may be very good at technical analysis, that is analyzing charts using various indicators, checking price action via currency history, but very bad at fundamental analysis, and actually this can cause you to lose a lot of money. You should be good at both. So you may be in profits according to the chart analysis you made, but this can be lost in a minute after there has been news release. So be mindful of both analysis for success in forex trading. You should always know that there is a technical analysis where we analyze the charts from mobile phones and computers, plus the web. You can also use the web browser to trade. So now we also have the fundamental analysis here. So this deals with the news releases and economic factor. You can use the below website for checking if there are news that are going to happen. So the websites you can use: Forex Factory, then there's FX Street. These are the most known. You can also get the apps or download other apps from the Play Store. I'm going to give you the links in a text which you can just click and you paste in your browser, and you just go direct to the website. And on these websites you can just set them to your local currency, to GMT or EST, depending on the country that you be in. Let's look at what is technical analysis, because we really have to know about what technical analysis is. So we see technical analysis focuses on the study of price movement. This is done by viewing of charts using indicators. We are going to be using indicators plus its own chart, the candlesticks, bar charts, line graph. But for us, we are basically going to be focusing on the candlestick charts, as I've been saying. So technical analysis uses historical currency data to forecast the direction of the market, the direction of future movements. So also the current market information is reflected in the technical analysis. So studying the price movement is all that is required to make informed trading decisions. So technical analysis deals with charts like candlesticks, line, and bar graphs. So it also varies the market indicator like Bollinger Bands, relative strength index, moving averages, Fibonacci analysis. There is bulls and bears power. There is volatility. All these oscillators, we are going to be integrating them with the charts so that we can have the clear market movements. So we also have and many others to see and predict the price action movement. So It also uses the support, resistance, and trend lines to tell where the market will reverse from. Technical analysis assumes that history repeats itself, and this is true because it's what we are all going to be looking at. What have practically done, and what the big institutions are doing, and the big banks are doing. History repeats itself in the whole fields, most fields in the whole world. So keep keen. Let's move on and we explore more topics about this technical and fundamental analysis. So these are the different candlestick techniques that we are going to be talking about. So we have different types of candlestick which help us to know the psychology of the market, and they show us if the market is tired, and also during the reversals, and also the volatility plus the trend. So these are the candlesticks we are going to be covering in our course. So we have the bullish harami, we have the dark cloud cover, we have the doji star, then we have the downtrend, evening star, evening doji star, engulfing, bearish, engulfing, bullish pattern, gravestone, doji hammer, hanging man, inverted hammer, long legged, long lower, long upper shadows. And these actually are very important, like how we are going to be explaining depth of them as we move on. So we have the morning star, morning doji star, on neckline, then piercing line, separating lines, shaven bottoms, shaven head, shooting star, spinning tops, the three black cross, three white soldiers, tweezer tops, tweezer bottoms, tweezer tops, uptrend window, and also there is the downtrend window. So we shall look at them, how they really affect the market movement, and why it is of very importance to you to know them. Because once you keep an eye on these candles, and you know that the moment I look at the hammer, the hanging man, or the dark cloud cover, I can easily know that the market is going to be reversing anytime. When I look at the dojis, I will be in with knowledge to know that the market is not deciding which movement. It's going to be in a consolidation. So this knowledge is going to be of very big importance to you. Start with the black body. So this one indicates the bears in the market. When the market is in a downtrend, we start it with the black body. So we see that here a candlestick formed when the closing price is lower than the opening price. So the signal is a bearish. Basically, on MetaTrader 4, these candles come in default colors of black and white. So where we see that the black candles indicate the bears when the market is moving in a downtrend, and the white candles represent the bulls when the market is moving in an uptrend. So here we see these black bodies, they show the bearish. They are showing us the bearish are in the control of the market. So, but on issues of colors is that you can choose your own color. You can decide if you want it to be in red or in black or in green. Any color that you wish to, you can change it via settings, maybe as how we shall see on MetaTrader in when we are doing the practicals. The people prefer different colors, but here I'm explaining this course basing on the default colors that come with it. Yeah, so now let's look at the bullish harami, right? Now wait, this is also another type of the candlestick. So when you look at it, when you observe, is that you see that this is its pattern that we are going to talk about. We see the doji is contained within a large body, and this picture, in fact, the doji is meant to be a little bit up, because in Forex the closing and opening are always on the same. Like this closing of this candle or opening of this candle is always going to be on the same line as this, not this. So this candlestick I made, sorry, is mostly found in other markets like the stock markets or the futures. So the implication here is that a bottom reversal. So now this candle was in a downtrend. So when we observe this bullish harami, this formation of the candles, is that we expect the market to reverse and go up and also vice versa. So note that this differs. This differs in forex and stock markets. In fact, is here. So this is how it forms. When you look at it down, you can see clearly that it is showing the closing here and the opening here, both being the same line. Okay, not like how it was shown above. So and here I already show that it is bullish RMB mostly in the stock market, but in forex this is how it happens. So basically, also stock market comes with different candlesticks. They don't resemble ones for forex due to the fact that forex has different time frames where you trade your candles. So let's continue and look at another candle, which is called the dark cloud cover. Yeah, so now the dark cloud cover, we see that a long white body. When we look here, we see a long white body followed by a black body. So this is the bulls and these are the bears, like how I told you in the default colors. So the following black candlestick opens higher than the white candlestick's high and closes at least halfway into the white candlestick's body. So it closes halfway. When you see this closing half into this candlestick body, you just know that this is a dark cloud cover, and we don't realize the shadows. Now these are the shadows. They are wicks but also shadows. So a bearish reversal signal during an uptrend. So if you see it during the uptrend when the market is moving up, just know that the market is going to be moving down. But now we have to be very careful when you observe these candlesticks. You don't have to just jump into the market. No, we are going to be mixing them with different tools, different indicators. Okay, these are the Eastern tools. We shall mix them with the Western tools. Remember, Western tools, we have the indicators so that we get clear confirmations, and also to know if such a currency that is having this pattern has news that maybe are going to affect it. So all this is going to help us to be able to succeed properly into the market. So this is how it looks like on your MetaTrader when you're checking on your graphs. So when you observe this, you just have to know it closes halfway to the market. So let's look at another candlestick and we move on. So here we have the doji star. So we look at sorry about this. So a doji star, we look at a doji which gaps above or below a white or black candlestick. So it confirms a reversal signal by the next candlestick. But now let me do a deep analysis here for you. Sometimes a doji it can show that the market is going to reverse, but also it shows that the market is tired. Sometimes when you see multiple decisions, it doesn't mean the market is going to reverse. No, it can show that the market is tired or there is indecision making into the market. So you will not be sure if the market is going to be in that consolidation and make a continuation. For example, if it is moving in an uptrend, then you observe dojis, many dojis, and the market is in indecision, not an uptrend, not a downtrend. So sometimes you might expect the market will fall, but instead the market continues moving up after a consolidation. So dojis, they are good for reversal signals, but they need other factors to be considered so that the signal can be extremely clear for you. So let's continue to doji star. So no, actually sorry, this is a doji star that I was talking about. Now let's go to the doji, the doji, because now they form almost the same. So the open and close are the same. What is open and close? This this is the opening, this is the closing line. So it forms like a cross where opening and closing are the same line. So there is no real body in this. So dojis are usually components of many candlestick patterns. So these candlesticks assumes more importance the longer the vertical line. So let's look at them. Now, this is actually what I was trying to explain when there is indecision making in the market. So when you look at them, they show that the market is tired. You see, they can form multiple dojis, and even these ones are dojis with small bodies. They can also be called dojis because there is no difference between them and a doji. Because on some brokers it can come when it's like this doji with the close, and another one it can come with a small real body, but that is always a doji. So now let's look at the downtrend window. So downtrend window, it's this is a gap between the low of the first candle and the low of the second candle, and this gap is always seen during the opening of the new week of trading. So if it is a Sunday night, that Monday morning when the market has opened, we normally observe the gaps in the market. So these gaps you can use, mostly what I observed is that you can use the gap as the resistance line. When the market comes and hits it back, it normally reverses back. So you can use it to trade, but you put your take profit on a reasonable amount, reasonable pips. You calculate like 20, 30 pips. You don't put it in a very big position. So we have the engulfing bullish pattern. Let's look at this. So we see that on its implication, we see that a small white body for bulls followed by and contained within a large black body. So when we see this, we expect a top reversal signal. So when the market is in a downtrend, and or when it is in an uptrend and we observe this, we expect the market to be falling. So we keep monitoring these candles. But the thing is, when you look at these candles, they can give you the picture of of what is happening in the market. But the truth is that sometimes you can't observe all of them to know all of their names. But you can easily know when you see it, you can easily know when you are in a position of a buy and you are in profit, you have to get off. Or sometimes when you are in a loss and you know that it's going to reverse and you reduce your loss, maybe you can reduce on a loss and still close if the trade was against you. So they can help you in various ways. So we have the engulfing bullish pattern. This engulfing bullish pattern. So yeah, we see a small body followed by and contained within a white body. It shows a bottom reversal like this. So this is the bullish, this is the bearish. So you see that the bear's body, it's contained fully into the white body, so it can also show the reversal signal, like here how we are seeing it in our example. So we have the evening doji star. Basically, let me first even explain about I've got this in my mind. Maybe someone can be confused about reversal signal. Like, what is reversal signal? No, the reversal signal shows that when the market is in a certain trend. Let me give an example. If a market is in an uptrend, it's moving up in bullish control, and you confirm these signals, they are showing a reversal signal that the market is going now to reverse from where the bulls have been taking control to where the bears are going to take control. So that is what actually the reversal signal that I should be what I've been talking about means. The market reverses and changes direction. It's like a change into the direction. So let's continue with the evening doji star. So we see a white body followed by a doji, like how we see here, that gaps above the white body exactly. So the third candle is a black body that crosses 50% halfway more into the white body. So a top reversal signal more bearish than regular evening star pattern. So when we observe this we are clearly knowing that the market is going to reverse and go into a downtrend. So let's talk about the evening star. Yeah, this evening star, it's let me expand it a little bit. So it's a white body followed by a small body, this one. Now for it, it's not like a doji how you see it, that gaps above the body. So the third candlestick is black body that closes 50% or more. So sometimes you can close this 50 or sometimes even 70%, but this can be showing us a reversal signal. So it's a top reversal signal. So when we look at it from here, we can see that all these are pips that were made. So if you observe it and you do a sell in early in the time, then it's going to really help you a lot to be benefiting and making very many pips in your trading. So now let's talk about the gravestone doji. So the open and close are at the low of the bar. So a top reversal signal. So when you look at it, you can know that the market is going to change the direction. So it's like this, actually. It's like a T which is inverted. So when you observe it on your graphs, you can easily know. So this is it here. And this is time frame hour 4. So you can see there was simple reversals. So you can make small amount of pips after observing it. Now we have a hammer, and this is a big deal also in trading. So it's a small body near the high with a low wick, with little or no upper wick. So it can come like this with a very little wick up, but mostly it doesn't even have. So that's why it was called a hammer, because it looks like a hammer. So a bullish pattern during downtrend. So when you observe it when the market is in downtrend, like here, you see, if you can observe this, you see a hammer there in blue color, and check the amount of pips it moved up. So it was a clear signal for anyone to make money here. So we have a hanging man, which is like an inverted, we can call it an inverted hammer. So a small body near the high with a low wick, with a longer wick, with little or no upper wick. What do I mean by little no upper wick? It's like adding a small wick here, or like a shadow. So it doesn't have those shadows. So the lower the wick should be several times the height of the body. So this one shows a bearish pattern during uptrend. So if the market is moving up and you observe this hanging man, it means the market will move down. So we have the inverted hammer. So it looks basically like the one we have seen below. So it also confirms the reversal signal of the bears. When you look at it, the market is in uptrend, and you look at this, it confirms. Now, like here, the inverted hammer even came with a doji along as a confirmation, which shows you that the rejection of the bears is inevitable. So the market has to fall again. So here the market falls after seeing this. So we have the long-legged doji. So we see a pattern with long upper and lower wicks. So implication is that a top reversal. So when you observe the long upper shadow, this one, and here this is the long lower shadow. So both can it can show you for the bulls and it can also show you for the bears. So when you observe these shadows which are being rejected in the market, so this one shows this one comes in when it is the market is in a lower trend, and you keep observing them be like this. Very many, they show that the market is going to reverse and go in an uptrend. So this is the long lower shadow, as how we can see it here. This the shadow means that the price has been rejected. So this is the price rejection from the bulls. So that we expect, due to this, the market actually was here. What you don't know, the body was here. Oh, this was the body. So due to the bulls pair, they had to reject back the price up to this side. So it means the next candles are going to be the bulls in control. So what do you do? Is that you buy. So long upper shadow. So this one, when the market is in uptrend and you observe these shadows, the longer the shadow, the more the reversals, because they show that the other side is going to be in control. So we have a morning doji star. So let's talk about this. So we see a large black body followed by a doji star that gaps below the black body. The next candlestick is a white that crosses more. So we see this is a bottom reversal. So these are the bears who were in control, and now we see a doji. Now we see the bulls. So it means when you look at this doji, it means that the market is going to go in an uptrend. So like how we see it here. So I told you in Forex, the closing and opening are always on the same line. As you see it here, it's always on the same line compared to what you will see in other markets like the stock market. Keep that in the mind. So we have a morning star. Morning star is having the same indication as the morning doji star, but the only difference is the body here. This has a small real body, the other one has no body. The closing and opening are the same. So this is a morning doji star. So after you observe it, you see the market moves into the bearish pattern. So we have on neckline. So in a downtrend, a black body is followed by a white body, the way we see it. But remember here, the closing and opening, it has to be the same. And sorry for this, not putting it on the same pattern here. I use it the candlestick for stock market. So candlestick with its close near the low of the candles of the black candles. Here, as we see the bearish candles. So a bearish pattern where the market should move lower when the white candlestick is low predicted in the next bar. So this is the on neckline, the way we observe it here. Sorry, this. So we have the piercing line. So a black candlestick followed by a white candlestick that opens lower than a black candlestick's low, but closes 50% to the body. So this is what we are talking about. So it shows a reversal signal. I should correct this. So this shows a reversal signal. So we have separating lines. So in an uptrend, a bearish candlestick is followed by a bullish candlestick with the same opening price. So in a downtrend, a bullish candlestick is followed by a bearish candlestick with the same opening price. So a continuation pattern, the existing trend should resume. So when you observe them, they don't give you any reversal signal. So the market keeps moving in the direction it was moving in. So we have shaven bottom. So a candlestick with no lower wick at all. So a bottom reversal is confirmed. So when the market is in uptrend and you observe this, you see, when you realize it's like a inverted hammer, it's like hanging man. So when you observe it, all you know that you add the little analysis of the Western tools, the indicators, Fibonacci analysis, so that you can know whether the market is going to be reversing. You don't have to just look at this and you bump into the trades. No. So we have the shaven head. So a candlestick with no upper wick, a bullish pattern. Now this one is when the market is in downtrend and you observe it. It means that the market is going to change the direction and go into the bullish trend, which is an uptrend. So we have the shooting star. So a candlestick with a small body, longer upper wick with little or no lower wick, a bearish pattern during an uptrend. So when the market is going uptrend and you observe this, it begins with a very, very long shadow, which shows that the market has been rejected. So this can show the market anytime it's going into a downtrend. We have the spinning top, a candlestick with a small body. The size of the wicks is not critical. So a neutral pattern usually associated with other formation. So they normally show continuation of the market into a consolidation where there is indecision making within the traders. So we have the three black cross. So three long black candlesticks with consecutively lower crosses that closes near the lows. So this shows a top reversal. When these ones happen continuously, they can show that the market is going to be in a reversal, and this is the vice versa of those the other one. When this one happens in an uptrend, it shows that the market is going to be in a downtrend. The three white soldiers. So we have the tweezer bottoms, two or more candlesticks with matching bottoms. So the size of the color of the candlesticks does not matter. So it shows a minor reverse. In fact, I'm going to provide with you an indicator in this course which shows you which you can install on your MetaTrader 4 on a computer, and it can easily read for you all these candlestick patterns. You don't have to cram all of them in the head on all of them. You're going to know them as time moves on. When you become a consistent trader, they will naturally come into your head. But for now, I'm going to give you an indicator that is going to help you so that they can easily read for you those candlesticks on a chart. So we have the tweezer tops. So two or more candlesticks with similar tops, it shows a reversal signal. Now this is the uptrend window, which happens during a weekend, and this gap, the gap here, it can either leave you in it can hit your stop losses or even put in a big loss. So that's why it is always good not to leave trades open on a Friday, regardless a loss or a profit. And we shall look at that and into the money management and trade management. So this is caused by the gapping of the opening of the week. So the white body now here represents the bullish pattern. So remember, we looked at the black body. Now I've looked at the white body. I told you that the default of MetaTrader 4 is black for the bears, white for the bulls. So when you see a white bodies, white candlesticks, they represent that here the bull was in control, the buyers were in control. So these are our candlesticks, and there are also other big knowledge that you need to know about candlesticks, but the good thing is that I'm going to provide you with an indicator that can show those with computers, and those who don't have, still you can be using the PDF and this video to know more about them and how we shall use them to with other indicators as how we shall be looking in the practicals so that we can be more profitable. Let's continue with our lectures. Hope everything is moving on well for you. With any questions, you can ask me via this platform, via WhatsApp, via email, via Telegram, everywhere that you wish to. I'm willing and eager to support you to the fullest. Go to the indicators. These are also known as the Western tools. They are very important to us because they can show us the where the market is going to go, prediction of the market. So we have different types of indicators. Many of these show us the market volatility, price action, and when the market is likely to reverse or even be in a continuation. So there are very many indicators. There are so many, but for us, we shall cover the Bollinger Bands, Fibonacci retracements, moving averages, and RSI. But there are so many that it's up to you to choose the indicators that you will be using. But to this course, I'm covering these ones, and they are the ones that we shall be using. And basically, we shall focus even on RSI. What I learned is that you don't need to know every information on us to be successful. No, you need to know what is going to make you successful. And me, I'm focusing on simplicity of the course so that you can become successful. So let's cover one by one. Let's look at the Bollinger Bands And we look at this is a technical analysis tool defined by a set of lines with two standard deviations, that is positive and negative, away from simple moving average, the SMA. So this tool was developed by a non-technical trader, John Bollinger. So standard deviation in Bollinger Bands is the measure of the volatility in the market. So when the market becomes more volatile, the bands widen, and during less volatile, the bands contract. So we can easily see them that when there is volatility which is going to come, we see them expanding, widening. So Bollinger Bands are three lines. That is simple moving average, which is the middle of the line, and we are going to look at them below, plus upper and lower band. Lower and upper bands are two standard deviation, that is positive and negative, from a 20-day simple moving average. You can modify this according to the settings and the time frame you'll be using. So this is the simple moving average, and these are the other two where we have the exponential. So settings, it's period 20 simple moving average, standard deviation 2. We can see all this all in the setting when we are in practical. So note that the closer the prices move to the upper band, the more overbought signal, and closer the prices move to the lower band, the more the oversold signal. So now let's look at the Fibonacci retracement, and these are also good indicators that we need to focus on. So this is used to estimate support and resistance levels based on Fibonacci numbers, also sequence. So it is a channel of lines that run diagonally. It can be applied in both uptrend and downtrend, as well as short-term and long-term trends. So lines are drawn at 223.6, 38.2, 50, 61.8, 78.6, 100, 161. So we have lines for the uptrend and for the downtrend to find the lows and the highs. Actually, these are the numbers I'm reading, as we are going to see below. So 161.8, 200, 261.8, 361.8, and 423.6% for some traders with a Fibonacci channel. But I'm going to give you a tool that draws Fibonacci direct to your chart. So that is how easy you're going to be comfortable with this course and gaining a lot from it. So with Fibonacci channel, the lines are diagonal and run parallel on the two selected highs in a downtrend, or two selected lows in a downtrend. So Fibonacci channels levels indicate future areas of support and resistance. So these are the lines we are talking. So you see they find the highs and they find the lows on different angles. Even this is like the low of this one, and here this is like the high. So it draws the patterns of support and resistance. So now let's talk about the moving averages. This is why they use the indicator in technical analysis that helps smooth out price action by filtering out the noise from random short-term price fluctuations. So it is a trend following indicator because it is based on past price movements. Most commonly used moving averages are the simple moving average, SMA, which is the simple average of a security over a defined number of time periods, and exponential moving average, EMA, which gives greater weight to more recent prices. So the applications of moving averages are to define the trend direction, determine support and resistance level. So you see support and resistance level, you can find it using these moving averages, and even support and resistance levels itself, even Fibonacci analysis. So support and resistance is a very good deal in the trading career because it can show the success. So here are the points to note. Simple moving averages take the arithmetic mean of a given set of prices over the past number of years. This can be previous days of 15, 30, 100, or 200. So EMA uses weighted average that gives greater weight to more recent days to make it more responsive to new information. So when the asset prices cross their moving average, it may generate a trading signal for technical traders. Now, finally, we are going to be focusing on this relative strength index. So RSI is a momentum indicator that measures the magnitude of recent price changes to evaluate overbought and oversold levels. So in the price of a stock or other asset, RSI is displayed as an oscillator and can have a reading from 0 to 100. So the indicator was originally developed by J. Wells Wilder. So traditional interpretation and usage of the RSI are the values of 70 or above indicate that the currency is being overbought, and this may make it reverse at any time. This implies RSI 30 reading and below it indicates the price is oversold, and anytime it may reverse. Note, for proper accuracy of RSI, one should set levels at 70, 80, and 90, and this is for overbought, and levels for oversold 10, 20, and 30. So period is we have 21, 14, 7 are better to use, but for us we shall focus on period 14. So these are how you can set them. We have the level of 90, we have the level of 80 and 70 for overboughts. And when the market hits 70, it can reverse. When sometimes it closes to 80 and to 90, the better, because there will be sure it has been oversold, way oversold. And this is, overbought. And these on yellow are the oversold. We have 30, 20, and 10. You'll see the market here on reaching 20. Let me mark there. You see at the market on reaching, this one. Just there is this mark, but here it reached 20 and it reversed. And even here you see the market reached 30 and it reversed back. Even here it reversed. So even here on 30, it keeps reversing on oversold and overbought levels. So that's how RSI works. That's its simplicity. So those are the indicators that we shall cover, but in practical part, even we are going to cover RSI because it can also help achieve the goals that you need in trading. So let's look at time frames on a different chart, and these are how they are displayed on a computer. So we shall look at how they are displayed on a phone later. So these are the time frames. We have different timing in Forex, which shows price action. So this starts from minute 1 up to monthly. So this is the timing of the price action as seen from different candlesticks lines or bar charts. So this is minute 1, minute 5, minute 15, minute 30, hour 1, hour 4, day 1, week 1, and monthly. What does this imply? That when you click on M1, it means each chart it's going to give you data based on 1 minute. So this is indications of minute 1 to monthly. So from M1, which is minute 1, it shows price action after every minute, and here after every 5 minutes, here 15, here 30 minutes, here 1 hour, here 4 hours, here day 1, here 1 week, and here a month. So this is data we have according to MetaTrader 4, but still you can go and check for other platforms which even show 6 hours time frame. So note that price action in minute 1 is different from minute 5, minute 15, as we are going to see. In fact, let me start from this, which is monthly. So this is the same currency, price action of Euro USD. But when we look at it in monthly, we can see each candle is representing 1 month. So this candle is representing 1 month, this is 2 months, 3 months, 4 months, 5 months. So each candle represents a month, as here it is indicating. So we can see the market is moving in a downtrend. When we look at our monthly, the market is in downtrend. So now when we look at this, now represents weekly. Each candlestick is representing per week. This is 1 week, this is 2 weeks, 3 weeks, 4 weeks. 4 weeks makes 1 month, which is the other pattern we had seen. So this is also 1 week candle. So which overall shows that the market is in downtrend. So sorry about this. So let's look at other time frames from day 1 up to minute 1. Look at the price action in hour 1 is that this represents, each candle is representing 1 hour. So we can see now the price is going up. But remember the other candlesticks, it was going down. So different charts show us different data. That's why you should have your trading goals. You know that I'm going to be a day trader, or I'm going to be a scalper or swing trader. So this also helps you. So now when you look at it in hour 4, this is how the chart looks like. Each candle is represented by hour 4. So now this is minute 1. Minute 1
Though I don't even recommend you should be looking at it. But now the market is showing it is in an uptrend. It's confused those, it's the noise to confuse those who don't know about the market so that they lose money. Because big banks, big people are trading swings, and they are trading intradays. They don't rush for these minutes. So minute 15 also, it's showing you the market is in uptrend. And minute 30, it's showing you the market is in uptrend. And minute 5, it's showing you it's an uptrend. So this is what we had covered, the math which these big companies run. It's a downtrend. So eventually, you who trades an uptrend, they will eventually overpower you and take your money. So you should be very careful. So these are the time frames in trading, and we should be very careful when we are choosing the time frame that we shall use, so that we can see if we can be overall a success in the trading industry. So let's talk about the support and resistance lines. So a support and resistance lines are the lines that we draw on a chart basing on our analysis according to price history. So a support level is a level where the price tends to find its support as it falls. This means that the price is likely to reverse after reaching that level. So a resistance level is the opposite support level. As the price rises higher, it's likely to meet the resistance level based on its history. So when we are setting support or resistance levels, we determine them from the highest level of price action and from the lowest level of price action. Note, sometimes support line is drawn by the price, and this makes it act as the resistance, and vice versa. And let's look at actually a more detail of it. This is how it looks like on a chart. This is a Euro USD minute one, no, monthly chart actually. This is a monthly, it was active in monthly, not minute one. So this is how the support levels work. We put them down on lower lows. We get the lower lows, and here we get the higher highs. So here we can put, let's say this is resistance 1, and here we put resistance 2. So here we put support 1, and here we put support 2. So we look for the lowest point when the market is in a sell, like here. The lowest, it's where we put, and we expect that when we put it, when the market comes back and hits that level, it rejects. But after 3 times, it always breaks out. So when we mark our resistance and support, we should know that when it rejects 1, 2, 3 times, it normally breaks. But this happens in bigger time frame, from hour 4 to months. You don't expect this to be happening in minute 30. But we shall look at it in practical, how it really works more, and why we need to use it. Actually, it's a simple tool that we can use mixed with indicators and the candlesticks to make it in trading. So now let's look at the trend lines, and this is plotting trend lines on a chart. Gives us a clear and crucial information about price movements. It shows points of support and resistance levels for the market. So as traders, we also find good entry and exit points. So it is a simple strategy, but very powerful and profitable if well measured. So let's look at an example to get more clues about these trend lines. So we look at the market into a trend. Now, this market is in an uptrend. So we can get the high, like how I've been saying, high points. That's where we start from, and we look where the market, we just draw a high point. We know that at one point the market is going to reach that high point and hits back. So the high points it's where we draw the resistance, and vice versa. On the support, we get the low points, and that's where we draw the support levels. And this is now a breakout. What is a breakout? It's when the market crosses your line of support or resistance, and when it becomes a breakout, now that line acts as now the resistance or support when it continues in future. So we got a breakout and then a consolidation. So now we start afresh to draw them like this. You keep drawing them, and we are going to look at this, how you can draw them on a mobile MetaTrader platform. This is how you can draw it on MetaTrader platform on the PC. So they are very simple to follow, and their strategy is really good and very profitable. So let's look at the fundamental analysis. And this is very crucial in forex trading, because what matters a lot is the fundamentals and the technicals, but also the psychology part is very crucial, how the market really is going to tease us. But now fundamentals are too important for us to know. Every trader should be knowing them. So we look at fundamental analysis. Fundamental analysis focuses on the economic, social, and political forces that drive supply and demand. So it's a trading tool that looks various on macro economics indicators such as growth rates, interest rates, unemployment, inflation, CPI. Of course, there are very many news that we are going to be looking at. So fundamental analysts will combine all the information to assess current and future performances. So traders of fundamental analysis have to be updated all the times about the economic changes and news releases all the time in order to be profitable. But the good thing is that technology, I told you, the bigger the technology grows, the more tools are easy to be accessed. Long time you'd be going to buy newspapers on the street, walking miles to look for them. But right now you just download an app and you have the news, even which notify you, send you a notification or an alert. Whether it is an application or software on a computer, everything is available. So let's note that currency price change, price move primarily based on supply and demand. So that is on the most fundamental level. A currency rallies because there is demand for that currency. So currency values decrease when there is excess supply. So supply and demand should be the real determinants for predicting future movements. So predicting demand and supply needs constant researching on the country. So factors that contribute to net supply and demand for a currency include capital flows, speculative needs, hedging needs, and trade level of price action. So we are going to be looking at deep analysis of the fundamentals and how they work and why we really need to know them, especially some of you who really want to be trading the fundamentals only. There are people who trade the news only and make it in the market, and others trade the technical analysis and make it in the market, and others, they trade basing on the psychology and their belief system. But that one, you have to mix a lot of knowledge, because belief system doesn't help you a lot here, but though it helps partly because positive impact on yourself is the big thing also. So let's go into deep analysis of these fundamentals. We understand them more. In fundamental analysis, we have the central bank policy. So that's a great way to find the best currency pairs to trade. So trading the best pairs gives you a higher chance of making more pips. But few retail traders know this knowledge. So let's talk about what is central bank. So central banks are responsible for settling the monetary policy of the whole nation. So according to the European Central Bank, it's their job to ensure that the economy is stable and growing. So a central bank primary focus is to manage the inflation globally and also in their countries. So, and also to reduce unemployment. All these are the factors that affect the market when they are releasing these news. So while enabling economic growth, so they also exist to ensure the banking financial system is as stable as possible and doesn't crash. So it is also it can also include issuing and maintaining the value of their currency, as well as servicing the last resort lender to the other banks and acting as the government's banker. So every central bank in any country, any given country, whether you are in Somalia, whether in Kenya, whether you are in Uganda, central bank action can influence the price movement of its currency, whether local or on international level. So now let's look at monetary policy. Now, what is monetary policy? So monetary policy is the way that central banks influence how much money is in their country's economy. It also influences how much it costs to borrow the money. So central banks have a variety of policy tools which they can use to achieve their mandate. So these tools may be used when the central bank feels the economy is overheating and needs propping up. So it's important to remember that monetary policy is different to fiscal policy. So monetary policy and fiscal policy should work hand in hand. This monetary policy and fiscal policy. So, but according to the Wall Street Journal study, this doesn't happen. It doesn't always happen. So the monetary policy implemented by a central bank will generally change over time. This will depend on which cycle the economy is in and how long the cycle is expected to last. So that is why central bankers pay so much attention to the economic data of their country. So now let's talk about the major central banks. So there are 8 major central banks that every forex trader should know according to Investopedia. So these central banks have the most tradable currencies. Information about their monetary policies are found below. So I have the United States, which is the Federal Reserve Bank. You have the European Union, which is the European Central Bank, Japan Bank of Japan, and even this can be a Federal Reserve System or the bank. So we also have the United Kingdom, which is Bank of England. We have Switzerland, which is Swiss National Bank. We have Canada, which is Bank of Canada. And we have Australia, which is Reserve Bank of Australia. We have New Zealand, which is Reserve Bank of New Zealand. So these central banks also have the most influence over the global economy, but the most influential in all is the U.S. Federal Reserve banking system. So this is because the US dollar is the most traded currency in the world, followed by the euro. So the structure of the central bank is slightly different. So the number of members and the number of times these banks hold policy meetings per year, they normally do it actually basing on monthly and sometime after a period of like 2 weeks. So it is these policy meetings and interest rate statements that all forex traders need to be aware of. But you can be aware of them by following them from Forex Factory or FX Street or Investopedia. There are very many pages where you can find these news. So let's talk about the Consumer Price Index. So the CPI is a broad measure of inflation within an economy in relationship to the cost of goods and services. So that figure can have a significant impact on the value of currency in relation to the currencies of other nations. So the CPI calculates the weighted average of prices of a basket of consumer goods and services. So including the cost of transportation, food and energy. So economists use the CPI figure to assess the price changes in individuals' cost of living. So when inflation goes too low, a central bank like Federal Reserve may cut interest rates in order to spur economic activity. So we look at when inflation is too high, interest rates may be raised to stabilize prices. So it's like the vice versa of law on inflation rates. So by increasing interest rates, a consumer may be more likely to incline to save the money rather than spend it. So due to the return they may generate by keeping it in the bank. So in the Forex market, the monthly CPI measure is one of the most important indicators monitored by traders. In the case of the US dollar, the release and revisions of the CPI figure by the Bureau of Labor Statistics can produce swings in the dollar's value against other currencies around the world. So the article explains how CPI affects the relationship between the dollar and its pairing. So we can see very big peak movements and spikes being formed during the release of this news. And its pairing with other currencies on the forex markets. So why does CPI matter to traders anyway? Let's look at this. So markets typically refer to CPI indicator as headline inflation. So the CPI data is critical in the currency market because inflation dramatically impacts the decisions made by central banks regarding monetary policy. So given the let me remove this. So given that central banks typically have a mandate to control inflation at a stable level, the Federal Reserve and Bank of Japan have both targeted an inflation rate of 2% annually. So policymakers raise or lower interest rates as a mechanism to reach these target levels. So they may also introduce other policy prescriptions such as bond purchasing agreements or the expansion of the money supply. So let's talk about how CPI data affects the dollar on the Forex market. So we look at the Federal Reserve, of course, this for the US has a dual mandate that affects its action on monetary policy. So the central bank wants to bring the economy to full employment. So everyone has to be employed so that they reduce these rates of criminology, which happens during the unemployment. So that is the goal of these Federal Reserve banks, and it wants to ensure a healthy rate inflation as the economy expands. So as a result, Forex traders see both unemployment and inflation figures as figures that will dedicate the central bank's further, that will dictate, the central bank's future decision on whether to cut, raise, or maintain the interest rates levels. So given the impact of an interest rate on the strength or weakness of the currency, traders can anticipate the impact of the central bank's actions and the impact of the dollar's performance in currency pairs. So Forex traders, we consider CPI and core CPI figures to be one of the most fundamental indicators for the performance of an economy. Between the two, however, the core CPI figure provides better look under the hood by excluding cost of energy and food sectors, which tend to experience great price volatility over time. So in the US, the Labor Department releases the CPI and CPI core figures, which don't include the cost of food or energy in the same measure. Should that number beat the market expectations, so the dollar typically sees a boost against other currencies. However, should these readings fall short of consensus expectations, because we have the consensus expectations and the actual releases as how we shall look at it on the platform of the news, so the currency will fall relatively to the other pairings. So let's look. However, the impact is not limited to the monthly report like all government data figures. So the CPI is subject to the revisions by economists. Such changes can fuel significant volatility in a currency's value on the global market. So the consumer price index CPI is critical indicator of pricing pressures in the economy and provides a gauge of inflation. Forex traders monitor CPI as it can lead to changes in the monetary policy by the central banks that will strengthen or weaken the currency against rivals in the market. So the strength or weakness of a currency can also have significant impact on the earnings performance of companies with presence in the main global markets or in many global markets. So these these are the fundamental drivers of the market. In fact, I was meant to start by giving you this as the highlight, but I started with explanations. So, but these are the fundamental drivers. These are the top 9 that move the market, and we shall be looking at them from the from where we shall be observing the news releases of high, low impact. So unemployment, we have NFP, we have interest rates, we have CPI, trade balance, central banks, retail sales, manufacturing, purchasing managers index, the PMI, then GDP and stock market conditions. But let's continue looking at them. This is like what we are actually covering. So let's continue. So let's talk about the gross domestic product. So the GDP economic data is deemed highly significant in the Forex market. So GDP figures are used as an indicator by fundamentalists to gauge the overall health and potential growth of a country. Consequently, a greater volatility in forex market is closely observed during the GDPI rally. So let me give you a brief introduction about the GDPI, which was developed in 1934 by Simon Kuznets. The GDP measures the output and production of finished goods in the country's economy. So usually GDP is measured in 3 different time periods: monthly, quarterly, and annually. So this enables economists and traders to get an accurate picture of overall health of the economy. So forex traders are most interested in GDP as it is complete health report card for a country's economy. So a country is rewarded for high GDP with high value of their currency. There is usually a positive expectancy for future interest rate hikes because strong economies tend to get stronger, creating higher inflation. So this in turn leads to central bank raising rates to slow growth and to contain the growing specter of inflation. So on the other hand, a country with weak GDP has drastically reduced interest rate hikes expectation. In fact, the central bank of the country has 2 consecutive quarters of negative GDP, may even choose to stimulate their economy by cutting interest rates. So about trading of currencies using the GDP data. So we have QOQ, which is quarter-on-quarter figures, tend to produce tend to produce much more variable changes in overall. For example, positive GDP figures, positive GDP figures beating estimates QOQ, which is quarter-on-quarter, may be fleeting when taking into consideration YOY, year-on-year data. So YOY data allows for a broader perspective which could potentially highlight an overall trend or how the market is going to be trending. So we have the stock market condition. So we look at the fact that some currencies work hand in hand with the stock products like gold, wheat, then of course silver, and many others. This brings in their volatility movements during the major increases in the stocks of these products that are also the major exports of the countries. So example, we look at Canada being the major export of oil. So this means the hiking of the oil prices will also hike the Canadian dollar. Australian exports gold. So these products should also be kept on view since they can change trends or lead to faster volatility in the forex markets. So like oil rising leads to the CAD rising and vice versa. When it falls, the CAD falls. The gold leads to the odd rising. So we have the interest rates. So interest rates make forex go around. In other words, the forex market is ruled by global interest rates. So a currency's interest rate is probably the biggest factor in determining the perceived value of currency. So knowing how a country's central bank sets its monetary policy, such as interest rate decisions, is critical or crucial thing to wrap your head around. So one of the biggest influences on the central bank's interest rate decision is price stability or the inflation. So let's talk about the manufacturing. Actually, I think We shall look more of the interest rates later when we are moving on. So let's talk about the manufacturing purchasing managers index, the PMI. So you need to keep an eye on these notes and read them further to if you really want to get a deep explanation, and ask me the questions if you get anywhere like confusion or you're not understanding. So the PMI is an index of the prevailing direction of economic trends in the manufacturing and service sectors. So it consists of the diffusion index that summarizes whether the market conditions as viewed by the PMI are expecting staying the same or contracting. So the purpose of the PMI is provide information about the current and future business conditions to the company decision makers, analysts, and investors. So how the purchasing managers index works, let's look at how PMI works. PMI is compiled and released monthly by the Institute for Supply Management, ISM. So the PMI is based on monthly survey sent to the senior executives at more than 400 companies in 19 primary industries, which are weighed by the contribution of the US GDP. So the PMI is based on the 5 major survey areas and that is new orders, inventory levels, production, supply, deliveries, and employment. Sorry. So the ISM, Institute of Supply Management, weighs each of these surveys areas equally. So the surveys include questions about business conditions and any changes, whether it is to be improving, no changes, or deteriorating. So the headline PMI is a number from 0 to 100. So PMI above 50 represents an expansion when compared with the previous month. So a PMI reading under 50 represents a contraction, and a reading at 50 indicates no change. So the further away from 50, the greater the level of change. So when we look at these and the countries that they are going to affect, because we can see the pairs, we can easily know that during the previous releases and the actual price, the forecast, we can know that the market is going to be in a bearish or a bull. Talk about how the PMI affects economic decisions. So we see the PMI and relative data produced monthly by ISM from its surveys are critical decision-making tools for the managers in a variety of laws. So an automobile manufacturer, for example, makes production decision based on the new orders it expects from customers. So in future months. So those new orders drive management is purchasing decisions about dozens of components, parts, and raw materials such as steel and plastic. So existing inventory balance is also the drive the amount of production the manufacturer needs to complete to fill at the end of the month. So suppliers also make decisions based on PMI. So a parts supplier for the manufacturers follows the PMI to estimate the amount of future demand for its products. So the supplier also wants to know how much inventory its customers have on hand, which also affects the amount of production its clients must generate. So PMI information about supply and demand affects the prices that suppliers can charge. So if the manufacturer's new orders are growing, it may raise customer prices and accept price increases from its suppliers. So on the other hand, when new orders are declining, the manufacturer may have to lower its prices and demand a lower cost for the parts its purchases. So a company can use the PMI to help plan its annual budget, manage staffing levels, and forecast cash flow. So investors can also use PMI to their advantage because it's the leading indicator of the economic condition. So this one we should be knowing it, how it works, and basically it can help us in swing trading. So the direction of the trend in the PMI tends to precede changes in the trend in major estimates of the economic activity and output such as the GDP, industrial production, and employment. So paying attention to the value and movement in the PMI can yield profit foresight into development trends in overall economy. So it's very good to know how this works and how it can help us to be very profitable. Now let's look at the retail sales, because they are also good news into the forex markets. So retail sales is data which is compiled differently according to the country and their bureau statistics. The Bureau of Statistics. So some countries have private companies for some data and government offices for others. So we will analyze the US retail sales data, which is compiled and released by the US Census Bureau. So this data measures total retail spending in store and receipts across the nation and its monthly rates of change expressed as percentage. So this data covers sales for durable and non-durable goods, ranging from food to auto at the retail level. So the data is divided into US retail sales and US core retail sales, which excludes autos and gasoline. So the auto and gasoline components are excluded as two elements are often very volatile. So the Census Bureau releases retail sales data for month over month MON and year over year YOY percentage changes. So month over month data is more of the two, as the data series is likely to show a surprise or unexpected reading. So markets are more likely to react to deviations from expectations. So here we see markets moving in uptrend and downtrend in a very short period of time and giving false signals, or sometimes they can dry your account if you're not careful, if you don't use the stop loss or trading stops. So other retail sales data sets such as core and X auto are released as month to month changes only. So data is collected for a retail sales control group month over month change. So this excludes autos, gasoline, and construction materials. So all retail sales data is released monthly, approximately 2 weeks after the target month. So retail sales reports are compiled from data received by the Census Bureau from around 12,000 stores, establishments, and retailers, including online outlets. If farms are randomly selected according to the certain criteria. So for minimum size business area, paid employees, and geographical areas, these factors help avoid clusters. A new sample is chosen every 5 years also. So the data is used to explorate the trend for retail sales throughout the entire nation. So retail sales are just for seasonal differences and number of trading days and holidays. So let's continue and see that data is collected for all types of goods, and online sales are also included. This includes restaurants and services related to direct sales of goods, while other services such as financial are not included. So let's look at the US core retail sales and X auto. So this data series is released to show the impact autos and gasoline have on retail sales. So autos have a very large sticker price and may adversely affect the total of core retail sales, as they are a large component of sales, around 25%. So auto data also includes the items other than new cars, such as parts and repairs, as well as used cars, motorcycles, and recreational vehicles. So gasoline prices can be extremely volatile, as there may be large changes at the pump due to the crude oil prices changes, as well as the supply demand changes in gasoline. So retail sales control group. So this data series excludes autos, gasoline, and construction materials. So this data is used to construct the personal consumption expenditure series, which is a gauge of inflation of the retail sales and data sets. So it may be one of the least influential on the forex markets unless there is an extremely large deviation from forecasts, as this would mean expansion or contraction in the construction industry and may be taking place. And when we continue to look further, more details about the importance of retail trade statistics is that we see retail trade statistics are a strong indicator of of the health of an economy and whether it is contradicting or expanding. So the importance comes from the fact that retail sales make up nearly one half of personal consumption, which in turn accounts for nearly 70% of GDP. So retail sales, in terms of direct economy activities, account for almost one third of GDP. So the percentage increases or decreases also gives a good indication of how fast the economy is contracting or expanding. So very strong or weak retail sales can also put upward and downward pressure on the prices. So retail sales surge, then upward pressure on the prices may eventually take hold, especially if the sales figures continue rising monthly after monthly. So the same is true when sales are very weak, putting down pressure on the prices as consumers spend less. Again, when the sales drop for a prolonged period, this data is set used by various organizations, governments, and non-government. So in the US, it is used to calculate the GDP by the Bureau of Economic Analysis, and it is used by the Labor and Statistics Bureau to calculate consumer price indices and productivity measurements. More importantly, perhaps the Federal Reserve uses this data to determine trends in the consumer purchases and therefore possible inflation pressure. It is also used by market participants to get a picture on the general activity and the direction of the economy. So on the other, one of the main reasons, is retail sales data can move markets is stronger correlation it has on the inflation. So look at high numbers for retail sales will usually be accompanied by strong numbers of inflation. So in the same way, rising inflation puts upward pressure on interest rates, so too does higher retail sales numbers. So traders consider the higher rates as immediate bullish for a currency. So with the lack of contrasting data, strong retail sales data should cause what currency to rally. So at least near term. So here in these retail sales, we see currencies move many pips, and they are high impact news which we should always put an eye on. So there are many there may be a lag between retail sales and inflation data, especially since the former is revised a month later for the final number, which is open to large variations. Large deviations from expectations in this data are common due to the variability of factors that drive retail sales. So we mentioned above autos and gasoline prices, including on the retail sales figures, as driving large fluctuations in data. So, however, even something as simple as severe weather, for example, can be a cause for this data to be much lower than anticipated. So we should be keen while watching it as our fundamental analysis. So on the day of retail sales release, it is necessary to look at the all other data releases alongside it. So retail sales figures are released together with inflation data, usually consumer price index. So let's look here where to find retail sales data online. So real-time economic data is available online for free. A good source for the economic data is in the US, which is nearly real-time, is Bloomberg. So Bloomberg media. So other sources are also included. Another widely used website for real-time economic data for countries worldwide is FX Street and Forex Factory, which has an economic calendar covering 42 developing and developed countries around the world. So this is a good deal where we can be covering them, looking at them for free. No need to pay a single penny monthly or what. So now let's talk about the trade balance. The trade balance also as a fundamental. Trade balance measures the ratio of exports to imports for a given country's economy. So if exports are higher than imports, a trade surplus, the trade balance will be positive. If the imports are higher than exports, a trade deficit, the trade will be negative. So importance is that knowing the exchange rate is obviously critical for any foreign exchange trader. But information on the next exports of the country can help to predict the future trends in inflation and foreign investment, and thus gives clues to the future behavior of any given currency market. So let's look at the background. Trade balance is derived primarily from these factors: the price of goods in a country, tax and traffic levies on the imported or exported goods, the exchange rate between two countries. So this last factor is fundamental to foreign exchange trading. So since the trade balance depends so heavily on the current state of exchanging rates between two countries, trade balance is key coincident indicator for the state of the foreign exchange asset market. So there are a number of measures for trade balance, but one of the chief sources of information on the state of trade in the US of the International Trade Report released monthly by the Census Bureau and Bureau of Economic Analysis. So this report is released around the third week of every month. So I expect during the end of the month, we are going to get this release of the trade balance. So, and the details, and here we look at the details, the performance of several exported goods and services in various of different sectors. So these are also the news that we should be watching. And here we go with NFP, the non-farm payroll. And these are very, very crucial news. They happen once every Friday at the end of the month, at the beginning of the month. So, they begin. So let's look at the NFP figure is the key economic indicator for the US economy. So it represents the number of jobs added, excluding farm employees, government employees, private household employees, and employees of non-profit organization. So NFP releases generally cause a large movement in the market. They move markets very big. So the NFP data is normally released on the first Friday of every month from 3 to 4 p.m. according to the time frame in East Africa. So this article will explain the role of NFP's play in economics and how to apply NFP release data to Forex trading strategy. So how does NFP affect Forex market? So NFP data is important because it is released monthly, making it a very good indicator to the current state of the economy. So the data is released by Bureau of Labor Statistics, and the next release can be found on the economic calendar. So employment is a very important indicator to the Federal Reserve Bank. So when unemployment is high, policymakers tend to have an expansionary monetary policy. So the goal of an expansionary monetary policy is to increase economic output and increase employment. So if the unemployment rate is higher than usual, the economy is thought to be running below its potential, and policymakers will try to stimulate it. So as cumulatively, monetary policy entails lower interest rates and reduces demand for the dollar. Money flows out of the low-yielding currency. To learn exactly how this works, see our article on how the interest rates affects the Forex. We had already looked at the interest rates. So when we continue, see that Forex traders must be wary of data releases like the NFP. Traders could get stopped out due to the sudden increase in volatility. So when volatility increases, spreads do too. We see widening of the spreads during the release of even minutes before the release is actual. So, and increased spreads can lead to margin calls. So which currencies are most affected by NFP? The NFP data is an indicator of American employment. So your currency pairs that include US dollar, like Euro USD here, USD JPY, GBP USD, OD USD, USD CHF, and others are most affected by the data releases. So other currency pairs also display an increase in volatility when the NFP releases, and traders must be aware of this as well, because they may get stopped out. Why do I mean getting stopped out? Your account can be banned or your stop losses are hit. So you have to be extremely careful here. So trading the NFP data releases, these are the top tips and further readings maybe you should follow. So yeah, the few tips to remember when using NFP data releases to inform your Forex trading. So NFP data is released on the first Friday of every month. The NFP data releases is accompanied with increased volatility and widening spreads. So currency pairs are not related to the US dollars could also see increased volatility and widening spreads. So don't say that because I'm in the GBP, nothing may happen. Anything can happen during the release of these news. So trading the NFP data releases can be dangerous due to the increased volatility and possibly widening of the spreads. So to combat this and avoid getting stop out, we recommend using proper leverage or no leverage at all. So these are part of the economic factors that we have looked at into the fundamentals, and we need to follow them, read them through the PDFs that I've provided for you. Ask me further questions via this platform, via WhatsApp, via email, via all the even Facebook, all the platforms I'm available to answer your questions. So let's proceed and continue with our course.
Talk about the analysis paralysis, and this is very common into trading. When you start trading, you'll be observing it. So here traders with many approaches towards the market tend to be overloaded. So it's tough to decide when you know enough to place a buy or a sell button with confidence. So many traders keep changing charts on different time frames to see if the strategy is okay. So the key to avoid this is by being confident about your trading system and the strategies you use. Don't fear to place a trade. Believe in yourself and know what you want. So you have to be strong. You understand? Be strong and stand strong. Be bold, stand strong about your trade analysis. Now, analysis paralysis is when you yourself you're fearing if the market is going to be up or down, and this happens when you do multiple losses because you thought your trading strategy was going to work. So now you trade the sale and you keep looking at the charts, the sell immediately goes into a buy, and now you are in a loss. You become depressed, you become confused, and it shouldn't be like this way. No, you should know that no, my trades are going to be a profit. Since I've set my stop loss and take profit, let me just leave the market. And analyzing the market too much is also bad. You analyze all time frames, you get confused from minute one to monthly, and even you're going to scalp and you're confusing yourself. You're putting different indicators, the RSI oscillators, you're putting volume indicators, you're putting Fibonacci analysis,